Picture this. It's Sunday, February 15th, 2026. A strange, quiet morning. Feel that? There's no noise from the financial newswires. No numbers dancing on the Asian electronic boards. The reason is simple. The Shanghai Gold Exchange, the place that sets the physical price for the world's largest buyers, officially closed its doors yesterday for the Lunar New Year. They won't be back until February 23rd. For the next 9 days, we're stepping into an information vacuum, a deadly silence I call a free fire zone. Go ahead, pour yourself a coffee and pull up a chair. You need to listen very carefully. Because when the East sleeps, the wolves in the West begin their hunt. We're on the edge of 9 days, where the paper price can be redrawn in any shape they desire, all while the physical vaults are bleeding dry. Thanks for watching. You cannot push the price below this line because if you do, we will just buy it all. But today that vacuum cleaner is turned off. The buyers in Shanghai are at home with their families, the banks are closed, the vaults are locked. And this creates a very specific, very dangerous condition in the financial atmosphere that we call a liquidity vacuum. Think of it like a football match, where the referee has walked off the pitch and half the opposing team has gone home. The remaining players, the big banks in London and New York, the ones we call the Comex Wizards, they now have the field entirely to themselves. And historically when this happens, they do not play fair. They use this time to paint the tape. Without the physical buying pressure from Asia, the volume of trading drops significantly. And in a low-volume market, it takes very little money to move the price away. This is where we see the phenomenon of phantom selling. You might see the price on your screen drop by 1%, 2%, or even 3% in a matter of minutes. But if you look closer, if you look at the forensic data, no physical metal is actually changing hands. It is just paper contracts being tossed back and forth between algorithms to create the illusion of a panic. And why would they do this? Why would they want to crash the price? Right now, to understand that, we have to look at the ledger. We have to look at the inventory. And this is where the story gets truly terrifying. I want you to picture a major international airport. Let us call it the Comex Airport. There is a flight scheduled to leave for March delivery. Now looking at the open interest report, which is public record, if you know where to look, there are currently claims for 327 million ounces of silver. These are people holding tickets. These are people who have paid for a contract that says they are entitled to silver 327 million ounces. Keep that number in your head now. Let us walk out onto the tarmac and look at the plane. How many seats are actually on this plane? How much silver is actually in the registered category sitting in the vaults ready to be delivered to those ticket holders as of the latest data I pulled before sitting down with you? That number is 98 million ounces. Do the math with me. You have 327 million ounces of claims, fighting for 98 million ounces of physical metal. Imagine an airline selling 300 tickets for a flight that only has 100 seats. In any normal world, that's fraud. But in the commodities market, it's just business as usual. They re-betting that most ticket holders won't actually show up for their metal, and will just take a cash payout instead. But what if everyone wants to board the plane? What if they all rush the gate at once? That's the panic the banks want to prevent. So, they crash the price on paper. They make the charts bleed red, hoping to scare nervous investors into selling their claims. They want you to give up your tickets so they never have to deliver the silver they don't actually have. It's a classic bait and switch, but on a massive scale. Stay informed, stay strong, and don't fall for their games. Thanks for watching, and be sure to subscribe for more insights. The Comex reports the total number of cars to make the lot look full, but when you strip away the private parking, the dealership is almost empty. And we know it is empty because of the bleed rate every single day. We are seeing an average of 785,000 ounces of silver leaving the vaults. It is a steady, relentless drain. The industrial users, the solar panel manufacturers, the electric vehicle companies, they are not looking at the paper price. They are looking at their production lines. They need the metal, and they are taking delivery. We have seen inventory drop by 70% since 2020. 70%, that is not a fluctuation, that is an exodus. There is one final signal that confirms this stress. A signal that is flashing red for anyone paying attention. It is called the lease rate in a healthy market. If I want to borrow a bar of silver from a bank to short the market, it should cost me almost nothing, maybe 0.3%. Because there should be plenty of bars sitting around doing nothing, but right now the lease rates have spiked. We saw them hit 8% in January, and they are currently hovering around 6.5%. Think about what that means. Why would someone pay 6.5% interest just to borrow a lump of metal for a short time? You only pay that kind of premium if you are desperate. It means there is no metal available to borrow. The banks are clutching their physical bars tight, refusing to let them go unless they are paid a massive premium. This is the internal scream of a broken system. The lease rates are telling us the physical market is tight, bordering on a crisis. Meanwhile, the paper price on your screen might show a sell-off. Do you see the disconnect? Do you see the fracture for the next week while Shanghai is closed? You are going to see a war between reality and illusion. The illusion will be the price on your screen, likely being pushed down to trigger your fear. The reality is the lease rates, the draining vaults, and the massive overbooking of the flight. They are trying to shake you out of your seat before the flight takes off, and they have 9 days of darkness to do it. You might be asking yourself, if the situation is so dire, if the vaults are bleeding dry, surely the price must explode upwards immediately. That is logical. But markets are not logical, they are psychological battlefields. And to understand what is happening in this quiet week of February, we have to look at the playbook of the establishment. We do not need to go back 50 years to see this. We saw it clearly in 2011. Do you remember what happened then? Silver was rallying hard. It was threatening to break the psychological barrier of $50 an ounce. The banks were caught on the wrong side of the trade, holding massive short positions. They were staring into the abyss. So did the free market allow price discovery? No. The establishment did what the establishment always does when they are losing the game. They changed the rules in the span of just 9 days. The CME Group, which owns the Comex, stepped in. They did not ban trading, but they weaponized the margin requirements 5 separate times in less than 2 weeks. They raised the amount of cash traders needed to hold a silver contract. Think about the brutality of that. Imagine you are winning a game of poker, and suddenly the house manager walks over and says, "To stay in this hand, you need to put up 50% more cash." Right now, the leveraged traders, the speculators, who were betting on the rise, were forced to sell just to cover these new deposits. It was a margin massacre. The price plummeted from $49 down to $26 in a matter of days. The banks were saved. The price was suppressed. Why am I telling you this on a quiet Sunday morning in 2026? Because right now, as Shanghai sleeps, the West is terrified that the price is about to break out again. But this time there is a critical difference, a difference that keeps the bankers awake at night. In 2011, the vault still had silver. The crisis was purely financial. It was about paper leverage. Today the vaults are emptying out. We are looking at 98 million ounces in registered inventory. That is the lowest level we have seen in modern history relative to demand. You cannot fix a physical shortage by changing the margin requirements. You cannot print silver bars. You cannot legislate more metal into existence. And this brings us to the most dangerous part of the story, the East. While London and New York are playing these paper games trying to manage the price with algorithms and margin hikes, the Oxys has been playing a different game entirely. They are playing for keeps over the last 5 years. We have watched a massive migration of wealth. We call it the Great Migration. Gold and silver bars have been leaving the vaults of London and New York, being melted down, refined into kilobars, the preferred size in Asia, and shipped to vaults in Shanghai, Mumbai, and Singapore. The BRICS nations Brazil, Russia, India, China, South Africa have been explicitly clear. They are moving away from the dollar. They are settling trade in their own currencies, and they are backing those currencies with hard assets. This is why the closure of the Shanghai Gold Exchange this week is so critical. Shanghai has become the price anchor. It is the only place where the price discovery is based on physical supply and demand, not paper speculation. Have you noticed the premiums for months? Now, silver in Shanghai has been trading at a significant premium over the price in London, sometimes 10% higher. Why? Because in Shanghai, if you buy a contract, you take the metal. In London, if you buy a contract, you get a cash settlement. The market knows the difference. The smart money knows the difference. So here is the setup for the next week. The West knows that when Shanghai reopens on February the 24th, there will be 10 days of pent-up demand waiting to be unleashed. The Chinese public, worried about their own property markets and currency, are panic buying gold, beans, and silver bars. The Comex wizards know this. Freight train is coming. They know that when the sun rises over the bunt in Shanghai next week, the buying pressure will be immense. So what is their only move? What is the only card they have left to play? They have to smash the price now. They have to use this week of silence, this holiday lull, to drive the paper price down as hard as they can. They need to trigger stop losses. They need to make the chart look broken. They need to scare you out of your position before the East wakes up. They want to cover their short positions at a lower price before the physical reality hits them in the face. It is a desperate gamble. It is the last stand of a rigged casino, but there is one thing they cannot control, and that is the industrial machine that never sleeps. While the traders might be on holiday, the factories are not. And that is where we find the final nail in the coffin. While the paper traders are playing their games with algorithms and margin requirements, there is another beast that does not sleep. It does not care about technical analysis. It does not care about the Shanghai holiday. It only cares about survival. I am talking about the industrial complex. You see, we often forget that silver is not just a monetary metal, it is a strategic military and industrial element. It is the most conductive metal on the periodic table. You cannot build a Tomahawk missile without it. You cannot build a solar panel without it. You cannot build an electric vehicle without it. And right now the supply chain managers at these massive companies, Tesla, Samsung, Lockheed Martin, they are looking at the same inventory reports that we are, but they are reacting very differently. They are not selling, they are panic buying. Let me give you a specific piece of evidence that the mainstream media has completely ignored. Look at what happened with the UBS SDIC Silver Futures Fund in China just before the holiday. But instead of people lining up at an ATM to pull out cash, it is corporations and sovereign nations lining up at the vault to pull out bars. And once that silver is used in a missile or a solar panel, it is gone. It does not come back to the market. It is consumed. We are entering the final phase of this supply squeeze, and when Shanghai opens its doors again, when the dragon wakes up and sees that the West has lowered the price while they were sleeping, well, that is when the real fireworks begin. So finish your coffee, enjoy this silence while it lasts. As we established at the start, the referee has left the field, and the game is about to get dirty. For the next 9 days, do not let the red candles on your screen fool you. If the price crashes to $22, ask yourself, can I actually buy a physical ounce at that price? The answer will likely be no. You will find the premiums rising just as fast as the spot price falls. We are watching a desperate attempt to paint the tape before the Shanghai freight train arrives. On February the 24th, they want your seat on the plane because they know the flight is overbooked. They know that 327 passengers are fighting for 98 seats. You have two choices this week. You can panic sell your ticket and take the cash. Or you can sit tight, hold the physical metal, and wait for the real market to wake up. I am not here to give you financial advice. I am just reading the flight manifest. The pilot is missing, the fuel is low, and the passengers are restless. If you want the full breakdown of the inventory data, I mentioned the link is in the description below. Do you entrust the screen? Trust the wait. Stay safe.